Welcome to Loss Reserving Fundamentals. If your organization purchases claims-made coverage, it may have uninsured exposure related to the potential for late reported claims. I'm Don Grimm, actuary and owner of Archer Actuarial Consulting. In this video, we will explore the source of this uninsured exposure, or tail liability, by using a few simple illustrations. Let's take a closer look at the source of tail liability. Tail liability is an inherent result of claims-made coverage. The coverage trigger for claims-made policies is different than that of traditional occurrence policies. For claims-made policies, the coverage trigger is the report date, whereas for occurrence policies, it is the occurrence date. This difference in coverage gives rise to tail liability for organizations that purchase claims-made insurance. Let's look at the following illustration to see why this is the case. Consider a diagram that represents one policy year with the occurrence date on the vertical axis and the report date on the horizontal axis. Let's look at 3 sample claims to see where they would be located in this illustration. In this example, Claim A occurs on February 1st of the policy year. It is reported on the same day, so it would be located here. Claim B also occurs on February 1st. However, it is reported 9 months later on November 1st. It would be located here. Lastly, Claim C occurs on December 15th of the policy year and is reported 1.5 months later on February 1st of the following year. These examples show how 3 different claims would be plotted on the diagram. In theory, a claim could be located anywhere in the orange shaded region. This area represents any claim that occurs in the policy year. Theoretically, this region extends to the right indefinitely. This area also happens to correspond to the coverage provided by an occurrence policy for this year. You may have noticed the gray shaded triangle to the left. In this region, the reporting date is before the occurrence date, and it is therefore impossible to have claims located here. With that background information in mind, let's take a look at how claims-made coverage is represented using this model. To keep things simple, let's consider how coverage would apply to a brand new company. Assume the company purchases claims-made coverage on day 1 of its operations. The violet-colored area represents the coverage provided by a first-year claims-made policy. Only claims that occur and are reported within the first year would be covered. There would be no coverage provided for claims that occur in year 1 that are reported after year 1. The region in yellow represents the tail liability related to a first-year claims-made policy. It is a liability to the company since it is uninsured at that point in time. In year 2, let's assume the company again purchases claims-made coverage. A second-year claims-made policy would cover any claims that occurred in year 1 or year 2 that are reported in year 2. There would be no coverage provided to any claims that are reported after year 2. The updated yellow region now represents the tail liability related to a second-year claims-made policy. In year 3, the company again purchases claims-made coverage. The third-year claims-made policy would cover any claims that occurred in years 1, 2, or 3 that are reported in year 3. Similar to before, the yellow region is updated to represent the tail liability related to a third-year claims-made policy. It is probably clear by now that the coverage provided by the claims-made policies, which is on a report year basis, will always give rise to uninsured exposure. This uninsured exposure stems from late reported claims, claims that are reported after the current claims-made policy year. This is the tail liability associated with claims-made coverage. It is worth noting that so-called late reported claims can sometimes be reported relatively soon after the occurrence date and still qualify as late. As an extreme example, consider a claim that occurred on December 31st of policy year 3. The claim is reported the next day on January 1st of the following year, so it would be located here. This claim would not be covered by the third-year claims-made policy and is an example of the type of exposure that gives rise to tail liability. Before we conclude, let's see what our 3-year policy period would look like if occurrence policies were purchased instead of claims made. This version of the diagram is much simpler. With 3 annual occurrence policies in place, any claim that occurs in year 1, 2, or 3 would be covered regardless of the report date. There is no tail liability in this scenario. One quick note. Although occurrence policies theoretically cover claims regardless of report date, insureds are generally obligated to report known claims to the insurer in a timely fashion. Otherwise, coverage may be denied. In summary, tail liability is the insurance exposure not covered by claims-made policies. The exposure is due to the potential for late reported claims. Late reported refers to claims that are reported after the current claims-made policy period. Organizations are generally required to recognize tail liability. They can do so by establishing loss reserves or, if available, purchasing tail coverage through the commercial insurance market. Thank you for watching, and be sure to check out our other videos for loss reserving fundamentals and visit us at archeractuarial.com.